Welcome back to the recording of chapter number 13, exercises part B. Means we are going to discuss the common stock, preferred stock, treasury stock, and retained earning and the honors equity section in the problem exercises of this chapter. So I have three problem exercises which I'm going to discuss in this recording. Please be with. Let's move on towards our next exercise, which is the problem exercise. Um, this is problem number 13-1. DeLong Corporation was organized on January 1st, 2017. It is authorized to issue 10,000 shares of 8% 100 par value preferred stock authorized. So we have authorized capital. 5,000 shares of no par common stock with a stated value of $2 per share. So this is authorized capital for preferred and common. The following transactions occurred during the year. We will read the transactions, but let's see what we are supposed to do. Part A says that journalize the transactions. Part B says that post to the stockholder equity accounts. Stockholder equity accounts only, no need for cash and other accounts. And they say use J5 as the posting reference. Now, because the reference is given, I cannot use T account. I need to properly make ledger accounts. Okay, because I have a reference account as well. Prepare the paid-in section of the stockholders' equity at December 31st, 2017. So let's go ahead. Firstly, January 10 issued 80,000 shares of common stock for cash at $4 per share. Okay, this is issue, but let's check. Do we have a par value? No, but we have a stated value of $2 and we are issuing in excess of stated value with $2. Okay, so let's generalize. Cash gets debit 80,000 shares multiplied by 4, 320,000. Common stock get credit with its stated value. So 80,000 shares multiplied by stated value, that is 160,000. Issue price is 4, stated value is 2, so excess is also 2. So 80,000 multiplied by 2, that is 160,000. Then March 1st, what happened? Issued 5,000 shares of preferred stock for cash at 105 per share. 100 is the par value, 105 is the issue price, so 5 is the excess. Okay, let's do this transaction. Cash gets debit 5,000 shares multiplied by 105, that is 525,000. Preferred stock gets credit with its par value, that's 100, so 500,000. Excess is $5 per share, so 5,000 shares multiplied by 5. You can also take a difference, that is 25,000. The next one is April 1st. Issued 24,000 shares of common stock for land, so non-cash, uh, non-cash assets you are getting by issuing the stock. The asking price for the land was 90,000. Advertised price, asking price, they both are negotiable, so they are not the fair values. The fair value of the land was 85,000. Yes, we can record the land with 85,000. Okay, so let's do this. April 1st, land gets debit 85,000, common stock gets credit with its stated value 24,000 shares multiplied by 2, which is stated value, so we get 48,000. Then comes excess. So excess is the difference over here because I don't have the issue price per share. So when I take a difference, that is 37,000. So this is paid in capital in excess of stated value common stock 37,000. Then what happened in my first, you issued 80,000 shares of common stock for cash at 4.5 per share. So stated value, remember, that's 2. So 2.5, because issue price is 4.5, 2 is the stated value, so 2.5 is excess. So cash will get debit and common stock gets credit, and paid in capital in excess of par, common stock will also get credit. Moving on towards August 1st journal entry, issued 10,000 shares of common stock to attorney in the payment of their bill. So we get a bill of 30,000, which is organizational expenses, and you issued 10,000 shares for that purpose. So organizational expense gets debit, common stock gets credit, 10,000 shares multiplied by stated value, which is 2, and then we will have excess account as well. So let's check August 1st journal entry. I will show my first because it's quite clear. Let's move on to August 1st journal entry. Organizational expenses gets debit. The bill amount was 30,000. Common stock gets credit 10,000 shares multiplied by 2 per share. So that is 20,000. And paid in capital in excess of stated value. So difference is 10,000. Moving on towards September 1st journal entry, what is happening in this? Issued 10,000 shares of common stock for cash at $5 per share. Remember, stated value is 2, issue price is 5, so 3 is excess. Please pass the same journal entry. And finally, November 1st, issued 1,000 shares of preferred stock for cash at 109 per share. So the cost of preferred, the par value of the preferred stock is 100. 109 is the issue price, so 9 is excess. Okay, let's quickly check this journal entry. November 1st, cash gets debit 109 multiplied by 1000, so that is 109,000. Preferred stock gets credit 1000 shares, 100 is par, so 100,000 difference 9,000 is my additional paid in capital, which is paid in capital in excess of par preferred stock. Now they said that prepare the journal entries regarding the equity accounts. Can you see here? We have cash. Cash is not an equity account, so don't make a posting for it. Land is not a T account, don't make a posting for it. Just let me rephrase. Cash is not a equity account, so no need to post it. Common stock we will post. Preferred paid in capital we will post. Here, preferred stock we will post, paid in capital we will post. Land we will not post because it's an asset, it's not an equity account. Common stock and paid in capital we will post. Cash again we will not post. Common stock and paid in capital we will post. From August 1, organizational expenses we will not post because it's an expense, but yes, common stock and paid in capital we will post. Also, September cash we will not post, and then November again cash we will not post. So let's start from the preferred stock account. um, do remember we need to have, if we have opening balances, we need to consider them. Okay, check here. Was organized on January 1st. It is authorized to issue 10,000 shares of 8% $100 par value preferred stock and 500,000 shares. This is the first year of their operations. That's why they are issuing the shares. So we don't have any opening balance in any of the equity account. What journal entries we pass, only those are giving us the balance. So let's check our journal entry. Preferred stock is getting credit in March, so we will take it. Then preferred stock is getting credit in November, so we will also take it. So I have March 1st reference, they said use J5. There is no debit, but yes, it is getting credit 5,000. And November 1st, it is getting credit with 100,000. So I put them. My ending balance becomes 600,000. Just like you learn how to prepare the ledgers, it's the same way we are preparing the ledgers. Then common stock. So January common stock is in many transactions if you see. So January transaction has common stock. April transaction has common stock 48,000. May transaction has common stock 160,000. August transaction has common stock with 20,000, and then September transaction also have common stock with 20,000. So if you see here, all these credits, I put them, and also the balance was increasing with every credit. So on September 1st, last time the balance was updated with 408,000. Then we also have paid in capital in excess of par preferred stocks because of two journal entries. It get credited journal entry number 2 and November journal entry. So March 1st journal entry has credited it with 25,000 and November 1st entry has credited it with 9,000. So ending balance becomes 34,000. Then paid in capital in excess of stated value common stock is also there because of all the above transactions except two transactions it get credited. So I put all of them over here and the ending balance also gets increased. Then they want us to prepare the owner's equity section of the long corporation. So we know that how to prepare it. Paid in capital has two main accounts, capital stock and additional paid in capital. They did not give us even retained. Did they provide? No, because this is the first year of operation, so we don't have a retained earning as well. Capital stock firstly will mention the preferred stock, so 8% preferred stock, $1 par value. Authorized shares are given over here. Can you see? Um, 10,000 shares authorized. How many issued? Journal entry number March 1st issued 5,000 shares and November issued 1,000 shares. So altogether 6,000 shares. Okay. See here, 6,000 shares issued and outstanding. So how 6,000 multiplied by 100, that is 600,000. Common stock no par $2 stated value, 500,000 shares authorized. It's given on the opening statement. How many shares issued and outstanding? Let's quickly see. Um, you have two ways to do that. You can either divide this ending balance, which is 408,000 of common stock, this one, with the stated value. What was the stated value? Let's quickly see. Um, Stated value is 2, yes. You can divide it with stated value, you will get 204,000. Or the other way is add all the shares you have issued. So that's little, time consuming. So you can do in both ways. 80,000 plus 24,000 plus 80,000 plus this 10,000 plus this 10,000. Okay. So if you add all of them, you will get 204,000. The other way, as I said, the balance you can divide it with 2 because you get this balance by multiplying number of shares with stated value, right? So if you need the stated value, divide the answer with the number of shares, or if you need number of shares, divide the answer with the stated value. We need number of shares, so we divided this answer with the stated value, so that is 204. So total capital stock is 1,008,000. Then additional paid in capital, we have preferred stock. I'm taking it from this T account. The preferred stock is 34,000 and the common stock is 457,000. I put both of them over here. Make a total. So total additional paid in capital is 471,000. When I add these two, I get my total paid in capital. Moving on towards the next exercise. This is a problem exercise 13-2. Fitcher Corporation has the following stockholders' equity accounts on January 1st, 2017. Common stock, $5 par value, 500,000 shares, paid in capital in excess of par, common stock 200,000 and retained earnings 100,000. In 2017, company had the following treasury stock transactions. Finker Corporation used the cost method of accountancy for the treasury stock. Yes, we always use the cost method, and the company's net income is 330,000. What they want us to do, they want us to journalize all these transactions relevant to the treasury shares, and also they want us to prepare the closing entry at December 31st, 2017 for net income. So we close the net income into the income summary account into the retained earnings, right? Then part B says that open accounts for paid in capital from treasury stock and retained earning, and post these accounts using J10 on the posting reference. So they want us to open these accounts and post them in the ledgers. And finally, they want us to prepare the owner's equity section. So let's do this question starting with the journalization. March 1st, purchase 5,000 shares, $8. So cost becomes par. So treasury stock 5,000 multiplied by 8, that is 40,000. And cash gets credit with 40,000. June 1st, sold 1,000 shares, $12 per share. So cost is 8, issue price is 12. So you are selling above cost with $4. So we will get paid in capital from treasury. So cash gets debit 1,000 shares, 12 is the issue price, 12,000. Treasury stock cost becomes like treasury stock cost becomes like its par, so 1,000 shares multiplied by cost, which is 8, so 8,000, and paid in capital from treasury stock. 4 was the excess, 1,000 shares, so that is 4,000. September 1st, sold 2,000 shares at $10. Okay, the purchase price is 8 and the issue price is 10, so $2 excess again. So let's do this. September 1st, cash gets debit, 2,000 shares, 10 is the issue price, 20,000 shares gets debit, 20,000 cash gets debit. Treasury shares gets credit, 2,000 shares, cost is 8, so 16,000, and paid in capital from treasury stock. How much excess? $2, so 2,000 multiplied by 2, that is 4,000. December 1st, December 1st, it sold 1,000 shares, $7. So our cost was 8, issue price is 7, shortage is $1. Okay. Can we debit paid in capital from treasury stock account? Yes, we can, because we have credited it 2 times. So let's do this. First, this June 1st entry has made paid in capital credit with 4,000. The second September 1st entry made it credit with 4,000, right? So I have altogether 8,000 balance in this account. Okay, let's do the December 1st entry. Cash gets debit, 1,000 shares multiplied by 7, 7,000 cash. Treasury stock gets credit with its cost, which is 8,000. How much shortage was there? 1. So 1 multiplied by 1,000, that is 1,000. Can I debit paid in capital with 1,000? I can, because I have a credit balance of 8,000. So paid in capital from treasury stock gets debit. They also want us to close the income of 30,000. So we know that this is represented in income summary account. So income summary accounts gets debit and treasury stock, retained earning gets credit. We did it in our assignment 1. So income summary gets debit and retained earning gets credit. Now, part B, they says open accounts for paid in capital from treasury stock, and retained earnings. Can you see here how many accounts we have? We have common stock, we have paid in capital in excess of par common stock, we have retained earnings, but we don't have any account for the treasury shares. So they want us to open these accounts and update them, and they say that use the reference number J10. Again, they are giving me a reference number, so I have to use the proper ledgers. So I'm using them. Firstly, paid in capital from treasury stock account, I'm opening. First sale and second sale, which was on June 1st and September 1st, it has credited my paid in capital from treasury stock account, and December 1st entry has debited it. So ending balance is 7,000. Treasury stock transaction account was not there. I'm opening it. March 1st, when we purchase treasury stock, we debited it with 40,000. June 1st, when we sell the treasury stock, we credited treasury stock with 8,000, so it reduced to 32,000. Then September 1st, we again credited it with 16,000, so it further reduces from 32 to 16,000. Then December 1st, we further reduced it with 8,000, so 16,000 is reduced with 8,000 and remaining becomes 8,000. Also, we need to update the retained earning balance. So opening balance was given in the question 100,000, and the last sale transaction of the last updating, or you can say closing entry of the income statement has credited retained earning with 30,000. If you see here, this one, 30,000 retained earning gets credit. So I have updated this account. So now I have ending balance of 130,000. Now I can prepare the honors equity section with these updated balances. If an account is not changed, then same balance will be taken. Stockholders' equity section, paid in capital and retained earnings are the two key accounts. In paid in capital, we have capital stock and we have additional paid in capital. We do not have any information of preferred stocks, only common stock, $5 par, 1,000 shares issued. If you remember, treasury stock is also there. So treasury stock has how much balance now? It's here. Treasury stock has an ending balance of $8,000, right? And what was the cost? Means the value, that was $8. Was it 8? Let's quickly see. Yes, $8 was the value. So 8,000 divided by 8, it comes up 1,000 shares are there in treasury balance still. You can also do it in this way by looking at the journal information. 5,000 where is the question? Yes. 5,000 shares were purchased. Then you sold 1,000, so remaining are 4,000. Then you sold 2,000, so remaining are 2,000. Then you sold 1,000, remaining are still 1,000. So you have 1,000 shares with you. So because we need to write it, na? So that's why. So 100,000 shares were for common stock, but 1,000 are still in treasury. So 99,000 shares outstanding. The balance is 500,000. Additional paid-in capital in excess of par common stock is 200,000 right here common stock, and from treasury stock it's 7,000. You prepared this account with me. Where is it? Here, right? So when you added them, that is 207,000, and now total paid in capital is 707,000. Retained earning also we updated. If you see here, this is the amount 130,000. So altogether, my total paid in capital and retained earning is 837,000. Then put the contra equity account with treasury shares. Don't forget to mention the number of common stock which is in treasury share. That is still 1,000. So 8,000. It's contra. So reduce it from this balance. 829,000 is the ending balance of equity account. The last question for this chapter is about problem number 13-3. The stockholders' equity account of Castle Corporation on January 1st, 2017 were as follows. We have preferred stock 8%, $50 par value, 10,000 shares authorized. $400,000 common stock, $1 stated value, and 2 million shares authorized, and the common stock value is 1 million. Okay, then paid in capital in excess of par preferred stock 100,000, paid in capital in excess of stated value common stock 1 million and 450,000. This is in dollars, this is also in dollars. It's also in dollars. Retained earnings $1,816,000. Treasury stock $50,000. How many shares? 10,000. During 2017, the corporation had the following transaction events and events pertaining to the stockholders' equity. We have some transactions mentioned over here. What we are supposed to do, we are supposed to journalize the transactions, and then we have to post them into the ledger accounts. But now here we have opening balances. In the previous question we didn't have opening balances, so when you will be preparing the ledger account, you will put the opening balances, and then you will be preparing the stockholders equity section. So let's quickly go through now, because we are very familiar that how to record the transactions. I will just discuss the transactions over here. I'll not take you down again and again, but I'll show you how to post them. So February 1st issued 25,000 shares of common stock for 120,000. 25,000 shares are sold, so cash is 120,000. Common stock will get credit with stated value, and stated value is $1, and remaining will go to excess account. Sold 6,000 shares of treasury stock. How much is treasury stock? 10,000. Okay. Now, students, treasury stock is debited with its cost, right? So, if 50,000 is the full value, and the 10,000 shares are there, so per share cost is $5. Okay, so you are selling the treasury stock for 33,000. So 6,000 shares out of 10,000 you are selling them. Then why I calculated this cost? Because the treasury stock will be credited with its cost, right? Let's check this transaction. So cash gets debit. with 33,000. Treasury stock gets credit 6,000 shares cost. Just I calculated with you over here 5. So 6,000 multiplied by 5, that is 30,000. So remaining is what? Why you are charging them extra? That is 3,000. That is paid in capital from treasury stock. So now we get this credit balance of 3,000. Okay. Moving on towards September 3rd, issued 5,000 shares of common stock for patent, valued 35,000. Now, patent is a non-cash asset. It's an intangible asset. So, what you're going to do, you will debit patent with 35 because they said valued. Valued means fair value, 35,000. And common stock will get credit. 5,000 shares are there. Stated value is 1. So, 5,000 common stock gets credit. And then remaining is excess, which is 30,000. If you see, it's mentioned over here. Okay, moving on towards November 1st, purchase 1,000 shares of common stock for the treasury at cost of 6,000. When you purchase, your treasury stock increase. Okay, so when you purchase it back, now your treasury stock is 6,000 debit and cash gets credit. Finally, determine that the net income for the year is 452,000. No dividends were declared. So we have to journalize it. Na? So close it into the retained earning account. So income summary gets debit and retained earnings gets credit. Now we need to prepare all the accounts. Can you see here? Enter the beginning balances in the accounts and post the journal entries to the stockholders' equity account. All the accounts of the stockholders' equity we will take, either they are preferred, common, additional paid in capital, treasury, or retained earning, all of them. But we will be putting firstly their opening balances, starting with the capital stock, and first capital stock is preferred stock. Its opening balance is 400,000. Okay, but we do not have any journal entry relevant to it, so I just put here the opening balance 400,000 and that's it. Then comes common stock. Its opening balance is given in the question, 1 million. Then February 1st you issued it, so first journal entry has credited your common stock with 25,000. Then third journal with September 1st journal entry also credited it with 5,000. So firstly 25,000, so it becomes 1,025,000, then 5,000 more, so it becomes 1,030,000. Then I will also do the paid in capital in excess of par preferred stock. There is no entry regarding preferred stock, but yes, we have an opening balance. Can you see? 100,000. So put this balance. And then paid in capital in excess of stated value common stock, 1,450,000. This is the opening balance and we have transaction for it. So all the transactions which has increased this account, put them over here, and then you get ending balance of 1,575,000. Then paid in capital from treasury stock account 3,000 because I made the T account for you before, that's over here. Then comes retained earning, its opening balance is here, and the last journal entry has increased it with 452,000, so it becomes 2,268,000. Then comes treasury stock. Opening balance of treasury stock was given in the question, and then April you have sold the treasury stock 30,000, and then November 10 you have again purchased 6,000, so ending balance becomes 26,000. Finally, it's the owners equity section of the company. Firstly, put paid in capital and retained earnings. Then under paid in capital, put the capital stock and additional paid in capital. Under the capital stock, we have firstly preferred stock, 8% preferred stock, $50 par value. How many shares authorized? It's given in the question, 10,000. And 8,000 shares outstanding, issued and outstanding, so 400,000. Common stock, no par, $1 stated value. Authorized capital is given over here in the opening statement, 2 million shares. Now, what is issued? One second. Look here, 2 million shares. Okay. Now, how do I calculate issued? I'll advise you go to the ledger of common stock. See, this is the ledger of common stock. What is the balance in the common stock? We know common stock is always recorded at its par value or stated value. So number of shares multiplied by stated value. right? If you need what is the number of issued common stock, so divide common stock with its stated value. Okay, common stock is 1,030,000, stated value is 1. So that's why we said 1,030,000 shares issued. Outstanding, don't forget to remove the treasury stock. Okay, so if the common stock issued is 1,030,000, let's check how much treasury shares are there. So treasury stock has a balance of 26,000. Okay, but we have two different values for the treasury stock. If you remember, let's go to the journal entries. Um, the first treasury stock was having a value of 5, and the second treasury stock, it's given over here, it has a different value at a cost of 6. You purchase them 1,000 shares, so it's also 6. Okay, 6 is the par value. So how much balance is there? 26,000. So if you divide the number with the amount, you get your treasury stock number. That is basically, if you calculate it, that becomes 5,000. Okay, so 5,000 shares outstanding, 5,000 treasury stock. So 1,130,000 issued and 125,000 shares outstanding. So remaining, when this amount is for the issued. So if you multiply issued capital with the stated value, you get your total common stock. Add these two, you will get your capital stock. Go to the additional paid in capital. Just pick up the balances from these accounts, these T accounts you prepared here. This is the balance for preferred, this is the balance for common, and this is the balance for the treasury. So we added all of them over here, and then we get our total paid in capital. Retained earning balance, also T account, you need, it's not here, but you can prepare it, the retained earning T account, or you can prepare the proper ledger. It's here, sorry, it's here, 2,268,000. So just put this balance over here. When you add these two, that becomes your total paid in capital and retained earnings, and then deduct the treasury stock. Again, let's check how this 5,000 came, though I explained here, but let's, for the second count, we will do it again. Check all the transactions relevant to the treasury stock. Okay, we have opening balance of treasury stock. How much balance was there? 10,000 shares were there, right? Then you sell 6,000 shares. So remaining shares, how many? 4,000 still with you. Then after that, you again purchase 1,000 shares. So 4,000 plus 1,000 is 5,000. So total number of treasury stock is 5,000. Okay. Opening balance is, look here, opening balance was 10,000. When you sold 6,000 shares. So when you sold 6,000 shares, remaining 4,000. But then you purchase back again 1,000. So total balance is 5,000. You can calculate this in this way and then deduct it from your issued capital. So remaining is your outstanding capital. Don't confuse with the amounts, better to do it with the numbers. Okay. And then this is your total owner's equity section for the balance sheet. So this is about the exercises of your common stock transactions relevant to the common stock, preferred stock, treasury stock, and also retained earnings. That's seen. We also prepared the owner's equity partial section. Now I'll come back again with the next recording, which will be relevant to the shaping of dividends by the companies, different types of dividends we will look into, and then we will also see the effects of dividends in different statements, and we will also see what is the self-dividend. And if you want to listen to that lecture, please subscribe to the channel so that you get a notification for the upcoming video. Thank you, everyone. Bye.